Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending March 24th, 2023. So another eventful week. Lots of action. We'll be focusing on the Fed in this review, but we also hear things like First Republic Bank, which by all accounts it's not a fact yet, but everything is pointing in the direction that it's about to fail. So likely it's going to be bought by a bigger bank, or it's going to be merged with something, or many things could happen. But First Republic Bank should be the second bank in the U.S. to fail, according to all indications that we have. This morning we're hearing about Deutsche Bank, where investors are protecting against a potential default. And the Deutsche Bank, in the last few years, been in the news for the wrong reasons. So the bad students like Credit Suisse was and Deutsche Bank are at the forefront there. So still lots of action, still a very fluid situation. So we thought we'd focus on the Fed, which is something that has more certainty to it this week in the analysis based on that. So maybe to start with a look at this week's markets at the close on Thursday. The picture is going to clearly change by the end of the day, because as I'm recording this, markets are just about to open on Friday. Rates are falling quickly, so more positive returns on the week for bonds. The stock market is volatile. We're seeing a pullback that should erase the gains that you see on the screen here. So I won't spend too much time here analyzing all of the numbers, but I'll just say that the Nasdaq this week was closed officially 20% higher than the latest low that was in late 2022. So the Nasdaq is once again in a bull market. So let's see how long it lasts, but this is a fact. Price of oil was down 5% on the week, still down 13% on the year. This is sending a signal that investors are seeing an economic slowdown. US dollar was lower, meaning the CAD, the euro, and the price of gold were higher. Now talking about the Fed. So the Fed hiked 25 basis points this week despite the recent bank turmoil. A few weeks back, everyone was expecting the Fed to hike 50 basis points, so they did have to change their stance a little bit because of the banking situation. Central bankers will tell you that they have different tools for different jobs, and they're completely right. But how long can we hike rates in the situation that we have now when the banks are in focus? It's a big open question. More on that in a second, but Mr. Powell was pretty clear and he repeated the message often, and he closed his press conference by saying that rate cuts are not their base case. So on the right of the chart you have blue is it's the past. What happened with the Fed fund rate over the last decades, but gray is the forecast from the markets, and markets are pricing in rate cuts starting late in the year. And Mr. Powell says it's not the case. So that brings us to the dot plot. So this is the forecast from the FOMC members, and 2023 is expected by the Fed to be at 5.1%. The leading rate at the end of the year, 5.1%. Now we're at 5, so some upside. Rate cuts in 2024. Interestingly, when you look at the forecast, they don't expect inflation to come back to target, but they do expect unemployment to jump by 1%. So the unemployment rate should be higher by 1%. So the Fed is telling you that they're not expecting that they'll be able to win completely the fight versus inflation, but their fight will slow the economy down enough that unemployment will rise, and that's when they will be more accommodative. So this is the message from them. And after that, as you can see, the dot plot is lower for the next few years, but the purple line is the market view here, and an important, it's mathematics here, but the Fed, we're seeing the median of the dots, so it's kind of a modal forecast by the Fed, and the markets, it's more of an average view. So the markets are pricing in some significant odds of a recession or a stronger downturn, and this is what makes the market forecast lower than the Fed. So both could be consistent, but of course, where will the rate end up at the end of 2023, the end of 2024? Likely somewhere between these two lines, unless of course the economy takes a turn for the worse. Now, on Wednesday, it was interesting that Mr. Powell was speaking at the same time as Miss Yellen. And remember, if you've been there for a while, you know that Miss Yellen was the former Fed governor, but now she's the Secretary of the Treasury. And Mr. Powell, during his press conference, said that households did not have to worry about the security of their deposits in banks, but at the same time, Mrs. Powell said that they didn't even consider extending the deposit insurance to everyone in the U.S. So diverging messages, spooking the markets, more volatility. But on the right, as you can see, central bank accounting is telling us that quantitative tightening continues, so more money is being pumped out of the system, so deposits are shrinking, and the flow towards money market funds, which are now attractive at the rate of 5% versus a poor little savings account that pays almost nothing. Well, money is going to money market funds, which is going to the Fed via the reverse repo facility. So this is pumping lots of money out of banks, so the pressure on banks is not done yet. And the last chart here, the Fed's message is pretty clear. Financial conditions are tighter because of the tightening of the monetary policy, of course, but also they will stay tighter because of the SVB situation. So they just recognize that tighter financial conditions are coming from that. They're not looking to compensate for that tightening. And in fact, this is by design because it helps the Fed fight inflation. If the banking crisis becomes worse and we have something that is like a worse recession than expected, then this should take care or do some of the heavy lifting to fight inflation, of course. But on the left, you have the yield curve, which is strongly inverted, which is by itself very restrictive on the economy. And on the right, if banks see pressure on their balance sheets, well, they will be less willing to lend. So the lending standards on the right, it's not something new. It's been going on for a while, but it continues to get tighter and tighter. And of course, if the credit cycle stops in its tracks, that should be quite recessionary if this is where we go forward. So. Lots of fluidity here, lots of risks here at IA Financial Group. The asset allocation team, the managed funds that we manage. It's been over a year now that we've been advocating for a careful stance, a defensive stance. It paid in 2022 because we had a bear market. Early 2023, the equity markets have been positive. The bond market positive too, but very volatile. The volatility in the stock market, it's been more muted than we would have expected. It seems to be that we have rotation between sectors. We have investors getting out, for example, financials and going into tech. So this is muting volatility, but the list of potential events that could shake the market at its core is getting longer here. So we still advocate a defensive position, and this is how we're positioned in managed funds, about 4 or 5% underweight on equities, long on fixed income, more duration in portfolios, some cash on hand. We're still positioned like that, and we're comforted in this positioning based on all of these stories coming in. And when we turn more bullish, we'll let you know as soon as it happens. So what to watch next week, we'll have the CFIB Business Barometer in Canada, so an idea of the optimism of small business owners. GDP in December was negative. January StatScans was pointing towards positive. In the US, the Conference Board Consumer Confidence should be down, and the core PC deflator should be pushing the Fed to stay with a hawkish stance because inflation is expected to stay stable at 4.7% in February, core inflation. So nothing here to change anyone's mind at the Fed on the inflation front. So to follow us, ia.ca/economy, everything you need is there. So have a good week, and I'll be back again next week with another edition of the Weekly Review.